Good evening, good afternoon, people, and welcome to another video by the Market Maker SA. Today we'll be talking about an SMC concept that has gotten some recognition throughout the world of traders, as people are really looking to implement it into their strategy, and it actually is proving results. So we'll be talking about the fair value gap, the FVG, and to get more in detail about it, we'll be talking just the foundational basis of the whole concept. We won't be talking about the advanced stuff that we will talk about in another time. But without further ado, let us begin. So, what is the fair value gap? The fair value gap is a price gap on a chart which refers to a price imbalance representing a range on the chart where little liquidity was provided. So, if you are trying to learn this concept of the fair value gap, you should already have a conceptual idea of what imbalance is. So basically what imbalance implies to a strong impulsive movement of a candle which price almost or always returns to cover. So basically imbalance is caused due to the imbalance between supply and demand. It's a point in the market where market creates extreme displacement away from price with extreme velocity, indicating that there was a strong imbalance between the supply and the demand of price, and in that case basically creates imbalance. It's a strong momentum away, it's a strong displacement away from price to another side. Now imbalance can come in many forms. It can come in a form of velocity, momentum, strong momentum away like news candles, or it can come in forms of a gap which refers to, let's say, in a market where for a little period of time where market is not printing any candles, it's just gap there, and then they will continue at a later stage. That gap there, it's imbalance, it's a displacement. Market has to always come back and fill those imbalance areas. That's one key important thing, because the suppliers and the demands will be imbalanced. So market creates those type of displacements, and market has to come back and fill those orders that created the imbalance and then rise away. So that's very key, that's very important, what imbalance is. But otherwise, before you start really learning what the fair value gap is, try to understand what imbalance is. So number 3, it's a zone on the chart. So this is imbalance. It's a zone on the chart where price moves easily due to an imbalance between supply and demand. So once again, just explaining what I was talking about, but this goes to more importantly about the fair value gap. So once this imbalance levels out price, the movement tends to slow down, and the fair value gap areas often act as support or resistance. So what this fair value gap basically means from a foundational point of view is it acts as a support or a resistance depending on the market context, depending on where you are in the market. So it can act for a place where market will come to rest and then create a reversal, or it's a point where market can get into that area, resist that area, and leave from that area. So that's very, very important right there. The fair value gap can often be used as a profitable opportunity for experienced traders who have the skill and knowledge to identify inefficiencies in the financial market. So inefficiencies referring to the imbalances, to the inefficiencies between the supply and the demand. So that's very key, that's very important. But you're gonna get to the point where you also call yourself a skilled trader, an experienced trader. So you will see these things in the market as we go through them. So yeah, that's what the fair value gap is basically. So a brief description of what the fair value gap is from here. As you can see, we'll start with the bearish fair value gap. What happens is the fair value gap is more or less, it's a three candle structure. So basically we have the first, second and third candle. The most important one between these two is the middle one. The middle one, the momentum that was caused through the middle one, is the most important one. Is the most important one, as market will be expecting market to then come back into that area. Now the first one and the third one are very key, as both the wicks that close those candles, they need to be marked out to indicate the middle one, and in that case the middle one will then be indicated as a fair value gap. So then after that, we'll wait for price to then come back into that area and then leave. So that's very important there. That's very crucial. The most important one is the second one, but the first and the third one are just as important, as the wicks need to be used to mark out the fair value gap, which is in the middle. And you can see on my right hand side, this is an example of a fair value gap that's invalid, as there is no imbalance. As you can see on the first one, there was imbalance. There was imbalance in terms of the momentum there. That's the imbalance that we're trying to fill. But as you can see in the second example, in the invalid bearish fair value gap, their imbalance has been filled by the market, as the third candle wick came and closed into their imbalance, and the first wick was then also closed, creating no space for market to come back into. So there is no imbalance that needs to be filled there. So this is what basically is a fair value gap from a basic point of view. We have a bullish fair value gap here as well. As you know, the first candle and third candle are not really that important. They're not that important, but they're also important. The middle one is important. The momentum in the middle is important. If the momentum is too much, it's too strong, the fair value gap is no longer a fair value gap. It's officially imbalanced and needs to be covered, completely covered. So that's important there. So you can see the first wick, they're indicating the open of the candle, and the other open of the candle in the third one. Those two are then marked out, and then the middle candle with the momentum, which is not that big but also not that small, but it's still considered momentum, is where market will then come back and fill that fair value gap. As you can see on the invalid one, as you can see, there was no space for the market maker to come and fill that imbalance, because the market already filled the imbalance with that big gigantic open wick there, and the open wick of the first candle as well was a bit too tight, creating no space for imbalance. So how do you implement or draw down the fair value gap? Number one, you identify a break of structure. So depending on the market context, you identify a break of structure, which will indicate a change of character and will indicate a directional point of view for you to go to. Number two, you identify if the order block that broke the structure has no down candle or up candle, basically the opposite candle of the momentum away from the order block. So a down candle is usually the last candle before the momentum, the huge momentum that creates the imbalance. The last candle, as long as the last candle is not an opposite candle of the momentum that market is going to, then you are fine. Otherwise, if it is the opposite, if it is like, for example, if the momentum running away is bearish, and the last candle before the momentum was bullish, then that bullish candle officially becomes an order block, and the fair value gap is officially imbalanced, and it has to be filled. It's null and void. So basically what you wait for is, if the last candle is also bearish and the momentum is also bearish, when market is coming back to fill imbalance, it won't fill the imbalance, it'll fill the imbalance as a fair value gap, because it has no order block to go back to. So that's very important there. That is very crucial. So number three, you check the candle's velocity or momentum. That's very key there. You check the candles, the momentum that ran away from the fair value, from the order block, or in this case just a normal movement away, creating the imbalance. It has to be strong. It doesn't need to. If it's too strong to the point where it's abnormal, that is when it's imbalance that completely has to be covered by a retracement. But otherwise, if it's not, if it's normal-ish, then market, it will be perfect for market to then come back into it and feel it as a fair value gap, not as an imbalance fill. So that's important there. Number four, check that the imbalance has been filled or not. So basically what this implies to is you need to check if that imbalance that we were first looking at as a fair value gap hasn't been filled by the market already. Because if it has been filled, then that fair value gap is officially null and void. So that's very important. That's very crucial to understand there. Remember, the fair value gap is a three candle structure, just as we saw in the last example.